Hey everyone, welcome back to Corporate Decoder, the place where we decode the cryptic language of corporate finance. And today we're going to unlock the secrets hidden within Ventas Incorporated's latest annual report. Get ready because this filing might just reveal some interesting moves in the healthcare real estate market. And we'll be digging into the numbers to see if this company is truly on solid ground or just putting on a brave face. Before we jump in though, if you love getting straightforward breakdowns of these dense corporate filings, make sure you hit that subscribe button. And hey, we've built a fantastic community on Discord where we break down these filings even further, so definitely check out the link in the description below. Alright, so we're looking at Ventas Incorporated's annual report for the year ending the 31st of December, 2025. This is essentially their yearly checkup, telling us how they've been doing financially and what their plans are for the future. Ventas is a big player showing up on the S&P 500 index. They focus on creating places where people, especially older folks, can live and get the care they need. Think senior living communities, medical buildings, and research centers. As of the end of 2025, they had a massive portfolio of 1,409 properties. Now, let's quickly look at how their different business areas performed. Their senior housing operating portfolio, or SHOP, brought in a whopping $1.18 billion in what they call NOI. That is a pretty big jump of about 36.7% from the previous year. This segment owns and invests in senior housing communities, and it seems like things are really picking up here. They had 752 properties in this segment by the end of 2025, and their occupancy rates were looking healthy at 87.3%, up from 84.5% the year before. The average monthly revenue per occupied room also climbed to $5,255. This boost seems to come from more people living in their communities, as well as acquiring more properties and converting some from their other business segments. Next up is their outpatient medical and research portfolio, OMR for short. This is where they own and lease out medical buildings and research centers. The II here was $590 million, a small but steady increase of about 1.9%. They owned 409 properties in this segment, and occupancy was strong at 88.6%. It looks like they're doing a good job keeping their tenants happy and renewing leases, which is key for this type of business. Then we have the triple net leased properties, or NN here. NOI actually dipped a bit, down about 3% to $588 million. This segment involves leasing out properties where the tenant pays for most of the operating expenses. The dip seems to be due to some properties being converted to their shop segment or being sold off. While NOI decreased, their same store NN NOI actually saw a healthy 5.8% increase, suggesting that the properties they kept are performing well. Overall, their total NOI reached $2.39 billion, a solid 15.7% increase from the prior year. This is a significant sign of growth, mostly driven by that strong performance in their shop segment. But NOI is only part of the story. Investors often look at something called FFO, or funds from operations, which gives a clearer picture of a real estate company's operating performance. Ventas reported FFO of about $1.6 billion attributable to common stockholders in 2025. That is a noticeable jump from the previous year. They also calculate normalized FFO, which adjusts for certain one-time items. This figure was $1.61 billion, also showing healthy growth. It means that after accounting for all the ups and downs, the core business is generating a lot of cash flow. Let's glance at their balance sheet. On the asset side, their net real estate property value is around $24.1 billion, up from $22.6 billion in 2024. This reflects their recent acquisitions and development activities. On the liabilities side, they have a substantial amount of debt, over $13 billion. However, a good chunk of this, about 74.5%, is fixed rate debt, which is good news in a rising interest rate environment. Looking at their cash situation as of the end of 2025, they had a strong $5.3 billion in liquidity. This includes cash on hand and available credit lines, which is crucial for covering their expenses and future investments. They've been busy managing their debt. They repaid some of their senior notes that matured in early 2025 and also issued new notes in June and December of 2025, totaling $1 billion. This shows they are actively managing their debt profile, refinancing and issuing new debt as needed. When we look at their major financial commitments, it is mostly long-term debt and payments tied to it. They've made progress paying down some of this debt, which is generally a positive sign. Now, Ventas is a REIT, which means it gets some tax benefits, but also has to follow strict rules. A big risk they highlight is losing their REIT status. If that happened, it would be a huge tax hit and severely impact their ability to pay dividends and operate. They clearly emphasize that they believe they are meeting all the requirements to stay a REIT, but it is a constant balancing act. Another significant risk they talk about is cybersecurity. In today's world, this is a major concern for any company. They outline the steps they're taking to protect themselves and their operations, but they acknowledge that no system is foolproof. A breach could really mess with their business and reputation. A key part of their business model involves working with third-party managers and tenants. This obviously limits their direct control over day-to-day operations. They rely heavily on these partners to run things smoothly and compliantly. If these partners falter, it can directly impact Ventas. So, what is the big picture here? Ventas seems to be navigating a complex industry with a clear strategy focused on senior housing, which is a growing market due to demographics. They've shown solid growth in their shop segment and are actively managing their debt and capital resources. However, the risks are real. They rely on the health of their tenants and managers. The cybersecurity landscape remains a constant threat, and maintaining their REIT status requires careful attention. Looking at the numbers, the increase in NOI and FFO paints a positive picture for their core operations, especially with their strategic shift towards senior housing. The significant debt load is something to watch, but their focus on fixed rate debt offers some stability. Overall, Ventas appears to be making savvy moves in a challenging but potentially rewarding sector. They are expanding where the demand is highest and are being financially prudent. But the inherent risks in healthcare real estate and the need for strong partnerships mean investors should stay closely informed. Alright, that is our deep dive into Ventas Incorporated's 2025 annual report. What is your take on their strategy and the risks they're managing? Let us know in the comments below. If you found this breakdown useful, please give this video a thumbs up, subscribe for more corporate insights, and don't forget to join our Discord community linked in the description. It is a great place to continue the conversation. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.